We think silver's going to hundreds. I think even Elon Musk the other day said, we got to have silver for AI and so forth. And it's essential in all the tech things and so forth. In the case of silver, it's hard to do because most silver doesn't come from silver mines. It comes from base metal mining. And the primary incentive for those folks is the base metal price, not silver price. I think you'll see silver with sharp sell-offs in the process reach at least 200. Silver capped. What's going on there? Is it a dog? Lead did it, copper did it, and I could find a dozen other markets that have done something similar. So put your seatbelt on and be ready for days like what we're seeing today at 200 to 300 an ounce. It might overshoot that new reality in the process of getting there. Markets are not always rational. Silver certainly hasn't been for 50 years. Just to get to the 3% is a doubling in the current relative value of silver to gold. So whatever gold does, silver could do twice as much just to get to the 2011 levels. In the next 7 months, silver doubled in a half. Boom, doubled in a half. We just had a drop here today, literally in a couple hours from, like $10 or so, about 15% in silver. You can go back at lesser price levels over the last couple of years and see also 10, 15% drops, fewer dollars involved, et cetera. And so as we proceed higher, and I don't think this is just a shin kick interruption, you'll see plenty of them, you're going to get volatility like this. Where suddenly 1 hour you see it here and 10% lower or higher the next hour as we rise. And I think silver is in an ascent to a new reality. Not just a nice move, but, to some new reality price level. And we've made this point from various angles of analysis over recent months to our subscribers. But what do we mean by new reality, and we can get into that.
We'll definitely get into that for sure. But, looking back, through all these interviews that I've had the pleasure to do and people such as yourself I had the pleasure to speak with, it seems like almost years ago we were talking about bifurcation, where we have a paper price and then we have a physical price. So I wanted to ask you, is this what we are starting to see today? And is something like bifurcation between a paper and a physical price, is it sustainable?
The real story isn't the 15% drop. It's how fast investors panic when volatility shows up late in a cycle. What he's describing here matches historical breakout behavior. Once an asset leaves a long consolidation, intraday swings expand dramatically, often doubling prior volatility ranges. As Michael Oliver has noted repeatedly, price acceleration phases don't move smoothly. They shake out weak positioning first. A 10-15% move sounds dramatic, but during the 1979 silver run, daily swings regularly exceeded that. The paper versus physical tension he hints at matters because futures set prices don't always reflect real-world availability. For investors, this means position sizing and time horizon matter more than headlines. And what Michael Oliver explains next reframes why this volatility may actually be a feature, not a flaw.
It's probably an expression of the tightness of what's going on, but it's just a reflection of the underlying silver crisis that we're facing in terms of supply demand and its essential nature. I think even Elon Musk the other day said something to that effect, that we got to have silver for AI and so forth, and it's essential in all the tech things and so forth. Used to be, silver primarily industrial use was in photographs. Snap a picture, the processing involved the silver in the film. Now it's solar panels, powered the solar panels, the AI, massive technology buildup and so forth, where silver is just everywhere in there. And maybe in microscopic levels, but nevertheless pervasive and essential. And yet we've had 5 years, I understand, of we don't focus on supply demand. I'm looking mainly at the technicals, although I am fully aware of larger fundamentals beyond just silver's industrial thing. But we've got 5 years of supply deficit to demand. And it's not getting better, despite the rising price. In most markets, if a commodity is too low to incentivize more of the commodity, you take the price up. Therefore, you produce more of it, more wheat, more sugar, whatever. The case of silver, it's hard to do because most silver doesn't come from silver mines. It comes from base metal mining. And the primary incentive for those folks is the base metal price, not silver price, even though they get a marginal amount of silver, which is the majority of the supply comes that way.
What's quietly exposed here is a structural flaw most analysts gloss over when they talk supply response. Michael Oliver thinks silver doesn't behave like oil or wheat because price signals don't directly control output. Roughly 70% of supply comes as a byproduct of base metal mining. That's why 5 straight years of global deficits, documented by the Silver Institute, haven't resolved themselves. Elon Musk's AI comment matters because it confirms silver demand isn't optional. It's embedded in future infrastructure. Rising prices don't magically fix this imbalance, yet Wall Street still assumes they will. For investors, that's a dangerous modeling error hiding inside consensus forecasts. Next, Michael Oliver explains why even a triple-digit price may not change this dynamic.
So it's kind of a unique fundamental and technical squeeze that's underway here. And that's why we claim it's going into a new reality. Don't think in terms of normality here. This is not going to be some normal bull trend.
That's an interesting point because, being that it's a lot of the secondary mines that bring silver to supply. Let's say silver price does rise to a good number. Let's just throw $100 out there. Does that then mean that this higher number is going to bring more silver into the market, or would that really not matter?
No, that level probably wouldn't. We think silver's going to hundreds, okay? And I can't pin it down, except to say that I know if you fundamentally go back and factor in the decay in the U.S. dollar buying power, in other words, the quantity of dollars that exist, which goes up like, 80, 90% every 10 years, the supply of dollars. I'm not talking dollar versus euro or yen or anything, but literally the buying power of the fiat unit. And if you factored in getting to a price that reflects 1980, for example, when it was 50, or 2011 when it was 50, you'd be in a couple $100 just to get back to that level in terms of real buying power. When a market makes mistakes, either overpricing or underpricing, and everybody's especially aware of overpricing because we've seen stock market bubbles. And whenever that occurs, too high for too long, when it snaps, it doesn't do it rationally.
This is where the conversation shifts from price targets to monetary reality. Michael Oliver is not arguing for hundreds as hype. He's anchoring it to dollar debasement, where M2 supply has expanded roughly 40% since 2020 alone. Adjusted for purchasing power, silver never reclaimed its 1980 or 2011 highs. Markets don't self-correct gently. History shows they overshoot when mispricing lasts decades. That's true in tech bubbles, housing, and commodities alike. The danger for investors isn't missing the top. It's assuming this cycle will behave like a textbook bull market. Next, Michael Oliver explains why silver's history makes this setup unusually explosive.
It quite often overshoots where it ought to be. So it goes too deep, or just like on the upside, it goes too high for too long and then snaps the other way. Silver's been caught in a box for 50 years. You can look at copper or lead, and we've run studies on this, where they were caught in a range for multiple decades, 1970s, 80s, 90s, 2000, and mid to late 2005, for example, copper had been in this old reality of price range. And it broke out, and literally in a couple of quarters, it quadrupled. And it wasn't in sync with other base metals. It was on its own, okay? Quadrupled in price literally in several quarters, going to a new reality, in other words. And then when it finally leveled off for the subsequent decades, past 20 years or so, it leveled off at a range that was like 4 times the average price of that prior range. But the process of getting from the old range to the new range was a thunderbolt. It wasn't, let's get up there slowly and methodological, in an incremental manner. It was literally ripped the page off. And it no doubt overdid itself in getting to the new reality and then pulled back into a new reality. Same occurred with lead in 2007. Very exciting metal. Okay. Silver's been caught in this 50-year range. Gold hasn't been caught in a 50-year range. It has eightfold moves. It goes way above the prior 1980 high or the 2011 high, et cetera, et cetera.
This comparison quietly dismantles the idea that silver's past behavior is normal. Copper's 2005 breakout is a textbook example. Decades of compression resolved in quarters, not years, with a 4-ox move before stabilization. Michael Oliver says lead followed a similar pattern in 2007. Silver is the outlier, suppressed far longer than any major asset class. Gold already corrected its historical error with multiple 8-fold advances. When markets finally break structural constraints, they don't ease into new ranges. For investors, the risk isn't volatility, it's misjudging how fast regime changes happen. Next, Michael Oliver connects this long suppression to why silver may not stop at fair value.
Silver been capped? What's going on there? Is it a dog? Is it really non-essential? Lead did it, copper did it, and I could find a dozen other markets that have done something similar over the past 50 years or so. But silver was contained. Well, it's no longer contained, and therefore it's going to do something excessive on the upside, getting to a new level of price reality. And it's going to be fast. And we're in that process, and we're just in that process.
The quiet part here is that silver didn't suddenly become valuable. It was artificially restrained, while other commodities were allowed to run. Michael Oliver says, 4 decades, silver lagged even as copper, lead, and energy markets repriced higher, not because demand disappeared, but because price discovery was suppressed through paper markets and concentrated selling. As Michael Oliver has argued repeatedly, when a market is capped for too long, the eventual release isn't gradual. It's disorderly. That's why this move feels excessive to observers anchored to old price ranges. Investors need to understand this isn't speculation. It's delayed repricing after years of distortion. And what comes next challenges even conservative expectations.
Only in the past month have we entered that phase. So put your seatbelt on and be ready for days like what we're seeing today. When you were interviewing me, silver had a drop from $82 down to 71. And everything's, it's the end of the world. No, it's, another 10% so drop in a heartbeat. And it doesn't interrupt the real process underneath that's going on.
Get to that the drop in a bit, but Michael, last time we spoke back in July, I think silver was in the 30s or so, somewhere around there, and we talked, and the numbers came out $60 an ounce, $70 an ounce, somewhere around year's end. And you nailed it. You got to that point, and now we are talking about this new reality. But I wanted to ask you, what led you to make that call back then in July, which you got right, and speak on this new reality that you're seeing?
This is where most investors emotionally fail. They confuse volatility with failure. Michael Oliver says, a 10-15% drawdown feels catastrophic only if you ignore context. Silver is still up multiples from mid-2024, while gold has moved steadily with far less torque. Platinum and silver historically overshoot during repricing phases, which is exactly what we're seeing now. The July call for $60 to $70 silver wasn't luck. It aligned with prior momentum breakouts and historical acceleration zones. Smart portfolio management isn't panic selling these moves. It's sizing positions correctly so volatility doesn't force bad decisions. Next, Michael Oliver talks. What matters is why that call worked.
We measure silver, we measure any market. We look at all kinds of asset categories, stock markets, bond markets, commodities in general, foreign exchange, especially the monetary metals, silver, gold, and miners. Okay. What was going on back then was you're already in a bull market. I mean, silver was already advancing. We put out a major buy signal in March of 2024. Silver was about $25, $26. We said, okay, it's coming out of its sleep pattern. It's been in since 2020. And whoosh, you shot up. chapter 35. And then you effectively spent a year in a range with two peaks at 35, October of 2024 and March of 25, in a like a $10 range. And then when you came back up toward the top of that range in, like you said, in June, July this year, we said, that's it, you're coming out of here. This time is the acceleration phase. No longer, let's gain $5 and halt and $5, et cetera. And so we whooshed up into the over 50. Okay. Fought there a little bit, and then next thing you know, we traded 82. Okay. Right.
What's critical here is recognizing that bull markets don't start at headlines. They start in boredom. Silver had already been advancing quietly from $25 in early 2024, long before mainstream attention returned. Michael Oliver thinks the year-long consolidation near $35 wasn't weakness, it was absorption, a classic setup before acceleration. Technical history shows markets that compress after an initial breakout often double expectations once resistance clears, which explains the rapid push through $50 into the 80s. This isn't random upside. It's textbook momentum expansion. Investors who waited for confirmation likely paid a far higher price. And the next signal didn't come from price alone.
That was a technical signal we got from the momentum of the price action. In other words, just looking at price and its momentum. And we measure momentum differently than most people do. Anyway, and that told us, okay, this time silver is going to accelerate more than you've expected to see. This time, what happened that caused us to say new reality commencing is the spread relationship between silver and gold. The mama metal, gold, and the lesser child of the monetary metal, silver. And as we just talked about, gold keeps making higher highs over the decades and silver's caught in a box. Well, the spread relationship, when we plot an ounce of silver into an ounce of gold and express it as a percent, we plot that, okay, and we analyze that technically. The close of November, we had a spread breakout, meaning while silver's been underperforming gold since that 2020 surge in silver, remember when the post-COVID thing, silver exploded, doubled, and gold went up 40%. Silver outperformed them, but in the years that followed, it eroded back down in relative performance, meaning it was going up with gold, but at a lesser pace. But that ended at the November close. And November, we closed in the mid-50s. Okay, here we are a month later with a couple of days left, and we're in the 70s.
This is the signal Wall Street rarely talks about. Relative performance, not absolute price. Silver breaking out against gold matters more than silver rising alone, because it signals capital rotation within monetary metals. Michael Oliver says, historically, when the gold-silver ratio turns decisively, silver doesn't just catch up, it overshoots, often violently. The November spread breakout confirmed that silver stopped lagging and started leading, something last seen briefly during post-COVID distortions. Moving from the mid-50s to the 70s in weeks isn't hype, it's structural repricing. And this relative shift may still be early.
Wow, $20 in a month, that's pretty cool. Well, what warned of that wasn't that silver's in an uptrend. It's been an uptrend for a couple years, no big deal. It's the spread breakout, when silver broke out relative to gold. The same thing happened back in 1979 during that rush in silver. It went from like the teens to $50 in 5 or 6 months. Okay, it's when the spread broke out, silver favoring over gold, that suddenly silver went rampant. And they both went up, but silver just left the page, okay? Same thing happened in 2010 during that already aged bull market in silver, been going up for years. There was a point at which its spread broke out versus gold, and in the next 7 months, silver doubled in a half. Boom, doubled in a half. Very quickly. We argued when the spread broke out this time in November that process is now commencing here for silver. And if you go back and look at that copper I talked about, or the lead charts even, when you entered that new search for a new reality you did it so quickly. It was always a couple quarters. It's very amazing. And the same with 79 to 80. It was a couple quarters, like 5-6 months.
The real signal wasn't silver rising. It was silver breaking free from gold. History shows this pattern is rare but violent. In 1979 and again in 2010, silver didn't just outperform, it detached completely once the spread flipped. As Michael Oliver has noted, relative strength breakouts are where exponential moves are born. Not at trend lines everyone sees. A $20 move in a month sounds extreme until you realize past spread breakouts produce 150% gains in under 7 months. This isn't momentum chasing. It's a structural reset that markets consistently underestimate. What follows tends to shock even seasoned investors.
In the case of 10 to 11, it was 7 months from the spread breakout to the peak of silver at 50. I expect in the next 6 months, and this is month 1 in the countdown, we're already closing November, we started, so December's month 1. But in the next couple quarters after that November close, I think you'll see silver with sharp sell-offs in the process reach at least 200 and possibly a lot higher in a rampage. Yeah, there'll be a correction in the middle somewhere, probably. There was in 1979, there was a little correction in the middle that fooled people. Same in 2010 to 11, there was a reversal month. There was a fake out, and you exploded more. So sometime, let's say mid to late first quarter, you might get a correction that you could really call a correction. Not what we're seeing today. This is just a quick jerk, okay? But sit back and give it a couple quarters. And I think you'll see that it doesn't just get to what you could call a fair value based on the degradation in the money unit, meaning $200 an ounce or so, but probably overshoot it vastly.
The mistake most investors make is assuming the correction means the thesis failed. In both 1979 and 2011, silver delivered sharp mid-cycle pullbacks that shook out weak hands before the real vertical phase began. Michael Oliver says, a move toward $200 sounds outrageous until you compare it to monetary dilution since 2011. The USM2 supply alone has more than doubled. Volatility isn't risk here. Poor position sizing is. If history rhymes, the correction won't end the move. It will reset psychology before the next leg higher. And that's where discipline matters most.
And plus, there's the other factor that, we haven't talked about. And it's not just that silver's a key industrial metal. It's a monetary metal. And when certain other events outside of the monetary metals occur, like we have an underlying earthquake-type crisis building in some major government bonds, our bonds, Japanese bonds, UK, etc. There's a lot of big bond markets where there's underlying crisis already there, just hasn't ripped open and exposed itself fully. And when that does, that'll create huge waves of doubt and panic and impacts on other markets like the stock market, down, etc. So all these factors can come into play, in which case the central banks go ape, absolutely crazy, trying to save their government bond markets, and therefore printing money, which is the lifeblood of what gold is. Gold is money. You destroy your paper, gold goes up, etc. So I think that's the real underlying major factor in play here, not just the silver supply demand. I think we're going to a new reality, and silver is now engaged in doing what copper, lead, gold has done repeatedly, and it's about to go into a new price reality, and likely if that new price reality is some zone of price over the next decade, of course it could be monetized as well.
This is the risk Wall Street avoids naming: sovereign bond fragility. Japan, the UK, and the US are all running debt profiles that only function if yields stay controlled, and history shows central banks always choose printing over collapse. As bond stress rises, capital doesn't flee into cash. It flees into money substitutes like gold and silver. Michael Oliver has repeatedly warned that liquidity crises start in bonds, not equities. This isn't an industrial metal story anymore. It's a confidence story. And once confidence breaks, price moves don't stay orderly.
We know that. at 200 to 300 an ounce, it might overshoot that new reality in the process of getting there. Markets are not always rational. Silver certainly hasn't been for 50 years. To stay suppressed in a range where no asset in the world has been suppressed in the same range for that long. Copper has it, lead has it, gold has it. Why has it? And when it decides to correct that error, quite often markets have a tantrum that goes beyond the correction, a reasonable correction level, and exceed it. They get excessive, both ways, in this case upside. So it wouldn't shock me in the process of going to a new reality of several $100s an ounce, let's say, or more, that it overshoots whatever that zone might be. And much of that should occur probably and literally in the next handful of months. Within 6 months, give or take, of our spread shift, silver versus gold. Let me make another point. If silver has just broken out of a range since the mid-70s on price, but only marginally. It took out 50, it went to 80, and it's not even a double yet. Get to 100, at least you could say it doubled, okay. The spread relation between silver and gold, when we measure it our way, which is divide silver into gold, expressed as a percent.
Markets don't correct gently after half a century of distortion. Silver's suppression while copper and gold repriced higher is historically abnormal, and abnormal regimes tend to unwind violently. A move to $100 isn't excess, it's basic arithmetic from a multi-decade base. As Michael Oliver has said in other asset cycles, the biggest moves happen when valuation anchors break. Overshoots aren't anomalies, they're features of regime shifts. Investors waiting for reasonable pricing often miss the heart of the move. The next metric makes that imbalance even clearer.
In 1980, it was 6.5% of the price of gold, 1 ounce of silver divided into gold. In 2011, when it surged in that other silver bull market, the spread got up to over 3% of the price of an ounce of gold. Right now, we're just above 1.5%. Okay, so why should, if silver's going to go into a new reality in terms of its price and more or less catch up to gold, for example, what it's been doing, why shouldn't the spread also maybe do that? Now think about that. I mean, just to get to the 3% is a doubling in the current relative value of silver to gold. Doubling. So whatever gold does, silver could do twice as much just to get to the 2011 levels. And if you go to the 1980 levels and to take that high out as well, why not? Price taking out the range high. Why shouldn't the relative performance take out its prior highs? That's over 6. Oh, good grief. I mean, divide an ounce of gold by silver and you won't believe where it might lead you. So I think that's something to consider. Now, we're not saying it's got to do that. But what we are arguing is in the 2 quarters after that spread breakout, expect something you didn't expect. Don't expect normal, okay?
This is where mainstream pricing logic collapses, according to Michael Oliver. At 1.5% of gold, silver is still historically depressed even after its recent surge. Just returning to the 2011 ratio implies a 100% relative move, without assuming new extremes. And if confidence cracks the way it did in 1980, the math becomes uncomfortable very fast. Relative valuation, not hype, drives this argument. Markets don't revert politely after decades of imbalance.